Today I'm going to talk to you about a new report that we have started in the World Bank. It's called Global Financial Development Report, and the whole idea of the report is to increase the profile of the World Bank in global financial sector development issues. And the first report that we've done actually focuses on the whole area of the financial sector policies after the crisis. Each report focuses on a theme, and the next one is going to focus on financial inclusion. But this is much more than a report, so I would like to draw your attention to the website, where there is plenty of data information, particularly on financial development. And if you're interested in benchmarking your country or in different dimensions of financial development. And just to give you a flavor, we've put together a very large database, which sort of is over 200 countries starting in 1960s, and this builds on work that we have done in the bank starting 10 years now. And basically we try to develop indicators of financial development, both for financial institutions and financial markets, over different characteristics that capture stability, efficiency, access, and depth. And I'm not going to go that much into it because we don't have time today, but I do urge you to go and look at this data and play with the data on your own on the website, just to give you a sense of the cool figures, etc. you could develop. This is how distorted the world map looks if you were to weigh the countries by the volume of their financial sector assets, for example. Okay, so let me get to the feature topic of this year's report. As you know, the crisis, the global financial crisis, really questioned the validity of our policy advice in the financial sector in many areas, and it has revived the notion that the government has a much more important role to play. And as a background to this study, we've conducted an informal poll of financial sector experts from around the world, and we've asked them questions about what they think about the role of the state in different areas of the financial sector that range from their role in regulation and supervision, competition policy, the importance of state-owned financial institutions, and even the role of the state in promoting financial infrastructure like information systems. And there, as you can see from this very short table, we've seen that there were quite different opinions, and the opinions varied across in terms of the role of the state. And our clients actually were looking to us to figure out what the crisis meant in terms of our financial sector policies. And one of the dangers of sort of moving ahead with reforms after a big crisis like this is that sometimes we draw the wrong lessons from the crisis. So in order to prevent that, we thought that 4 years after Lehman crisis, it was a good time to take stock of what we knew before the crisis, what the crisis taught us, and where we go from here. So I'm going to tell you very briefly what are some of the main messages of the report in these 4 areas. But again, the report itself contains a lot more information and background work, so you may want to refer to that later on. So one area that the crisis certainly questioned is the effectiveness of the regulation and supervision as a result of this crisis. Now, clearly, this is not an area where the role of the state is disputed, but crisis also showed major shortcomings in market discipline and regulation and supervision. So the question here is not whether the state should be involved, but how to best ensure that the state role as regulator and supervisor supports sound financial development. And there are important trade-offs here. If you have too much regulation supervision, you would hamper growth and innovation. But if you have too little, obviously this may lead to crises. So there are calls for not more regulation, but the right type of regulation. And I think the most important contribution of the report in this area is based on a survey of regulation and supervision that we have conducted as an update of a survey that we've been doing for the last 10 years. And this survey covers 142 countries and over 730 questions, very detailed questions on the regulation and supervision around the world. And using the survey that was updated in 2011, we could address two questions. One is how did regulation, supervision, and market discipline differ among different countries, those that suffered the most from the crisis versus those that fared much better as a result of the crisis? And secondly, how did regulation and supervision and market discipline really change since the crisis? Okay, so this figure gives you some interesting tidbits and as to how regulation and supervision was relevant with respect to stability, because you could see that those countries that suffered the most from the crisis also had the least rigorous regulatory and supervisory environment. They had broader capital definitions. They had more sophisticated, they allowed for more sophisticated modeling of capital. So there were more room to conduct regulatory arbitrage. There was less strict provisioning. And also, even when you look at the market information, there was less oversight of external auditors, lower standards for public data quality, and so on and so forth. So overall, basically, crisis-hit countries really had weaker regulation and supervision practices and less scope for market incentives, because there was much more also generous deposit insurance coverage, which also undermined the incentives of the individuals to exert market discipline, and the lower quality of published financial information. Now, after the crisis, when we look at what's happened, we see that countries actually stepped up efforts on macroprudential policy, crisis resolution, consumer protection. But again, it was unclear whether the incentives for market discipline improved, because as a result of the crisis, we saw the safety nets become even more generous, so that's a concern. And surveys suggest that there's scope for improving disclosures and monitoring incentives. So basically, this part of the report suggests that there is broad agreement that it's important to address basics first. And one of the important findings of the report is that when it comes to regulation, sometimes less can be more. Simpler but more strongly enforced regulation tends to work better, because it's easier to enforce and it improves accountability. And also we see that across the world, the supervisory capacity in many of our client countries is quite weak and needs to be strengthened. So, if regulatory reform leads to a more and more complicated regulations that are even more difficult to enforce, this is very difficult in environments where the supervisory capacity is weak. And the other important challenge of regulations, of course, introducing reforms that are incentive robust. So the market participants have less incentives to try to circumvent the reports and the regulations. So in there, the report suggests that in addition to auditing core principles, it might be a good idea to also conduct audits of incentives so that the regulators and supervisors are aware of potential incentive conflicts and the regulations are designed accordingly. So one of the advantages, I guess, after the crisis is that there is a lot more interest in regulation and supervision, a lot more communication across different groups, policymakers, regulators and supervisors, and the market participants. So while this is certainly an ongoing process going forward, we hope that the outcomes will improve as a result of that. So a second area where the crisis questioned policies is in competition. There were calls after the crisis for reduced competition because some individuals and some analysts thought that potentially too much competition was the culprit in the crisis. So if excessive competition is destabilizing, then what should be the role of the state? Should it be actually restraining competition? So we've done a lot of work in this area in preparing this report, both in terms of summarizing the existing evidence, but also conducting new research. And there we see that actually leading up to the crisis, the market power and instability, systemic instability, were increasing hand in hand. So it's not true that greater competition is necessarily leading to greater instability. To the contrary, if the state sort of improves market contestability and this is complemented with availability of credit information and contract enforcement, and if the governments avoid policies such as too big to fail policies that distort risk-taking, this does not necessarily lead to instability. Therefore, the right policies for the government is to ensure that there is market contestability through healthy entry and exit. Okay, so a third area where the crisis reignited debate is on the role of the state-owned banks. As you know, before the crisis, there's quite a bit of consensus that state-owned banks are not associated with desirable outcomes around the world. Therefore, they are generally linked to politicized credit allocation, inefficiency in banking, leading to lower development and growth, and therefore there was these widespread privatization efforts. Now, one thing that came up as a result of the crisis is that obviously there were credit crunches, and the governments around the world found it convenient to use their state-owned banks in order to try to offset these credit crunches. And then this raised the question whether this potential counter-cyclical lending that could be done through state-owned banks in the aftermath of crises justifies their existence despite the potential problems related to their politically motivated lending and the past experience with state-owned institutions. And again, here we did quite a bit of research trying to understand the role that the state banks play in in the business cycles. And we've seen that there's quite a bit of research in terms of trying to see what role state-owned financial institutions play in terms of promoting efficiency and promoting growth, but there wasn't as much in terms of what they do during downturns and upswings. And looking at that sort of led to some interesting findings. For example, we do find that indeed state-owned bank lending tends to be less procyclical. And this is also possible that it is actually counter-cyclical in environments where there is good institutions, and particularly in developed economies. And but it's also true that there are some regional differences. For example, we see that there was some evidence of counter-cyclicality in LAC during the last crisis in Latin American countries, whereas this wasn't the case in the European countries. And even in those countries where we did see some counter-cyclical lending, when we looked in greater depth into those cases, we saw that actually the loans were not necessarily directed to the most constrained borrowers, and lending growth by the state continued even after recovery. So questioning whether this was truly counter-cyclical. So this is an area clearly where there could be important trade-offs, but for sure the crisis experience does not negate all the important empirical evidence that already exists regarding the potential negative effects, efficiency effects of having large state-owned financial institutions because of politicized lending. But there is still some potential also for using these institutions as counter-cyclical tools. Now there, obviously, the challenge is to address the potential governance problems of making sure that these institutions are governed well, and the experience with a lot of these institutions suggests that the good practice examples are not all that plentiful. And indeed, as background for this report, we also relied on a large survey of development financial institutions. And we did see that it's difficult to identify a lot of best practice cases, although we do have information on what makes it best practice in order to address the inefficiencies in state-owned banks. And there it's important to have clear and sustainable mandates. It's important to have adequate risk management systems, sound corporate governance, but good governance practices are really challenging to implement in weak institutional environments, and that's why we don't see too many success cases in practice. And this sort of questions the wisdom of trying to use these institutions as short-term counter-cyclical tools and disregarding the longer-term costs of these institutions. So a final area where there has been a lot of discussion as a result of the crisis is the importance of credit information sharing, and again, the role of the state in making sure there is adequate, good quality credit information. And before the crisis, again, the conventional wisdom in this area suggested that, well, there is provision of credit information both by the state and by the private sector around the world. And as long as, there is good quality information, it doesn't really matter who provides it. Now, some of the work that we've done as a result of the crisis and as background for this report actually suggested there could be an important role for the state, particularly in concentrated environments where private information sharing is less likely to emerge when banking systems are concentrated because of monopoly power. So certainly the state, again, there has a very important role in kickstarting the availability of information. And the state also has and can have a very important role in increasing participation beyond banks to non-banks, because having information across a broad range of institutions is also important in making sure that this credit information is complete. There is, as I said, a lot of detailed work in the report, but I just want to now conclude to give you some time to interact and ask me questions. But just to leave you with some main messages of the report, basically we do see that the state has a number of important roles to play that range from being promoter, owner, and guarantor, and regulator, supervisor, and overseer of financial system. And the right balance really depends on a number of factors, including the level of development and the government's capacity to engage in these activities, and this certainly leads to trade-offs. And when we look at the experience during the crisis, we see that there were quite a few direct interventions during the crisis, and there is certainly evidence that some of these work, partially at least in the short run, but also robust evidence that there could be potential longer-term harmful effects of these types of direct interventions. So as the crisis subsides, there's certainly a need for rebalancing towards less direct involvement. If I were to leave you with one thought as a result of this study, the overarching theme that we identify is the important role of incentives in finance. And really the challenge for the state's involvement is to better align private incentives with public interest without taxing or subsidizing private risk taking. And this is going to be obviously more and more challenging in a globalized and liberalized financial system. So thank you very much.